SoFi stock raised their full year revenue guidance today, and the stock fell so hard they actually had to stop the trading on shares. We got to talk about this. What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about SoFi Technologies, ticker symbol SOFI. This stock was down big time today, down under $5 per share. I am recording this with another hour left in the trade. Markets look like they want to claw back. In the case of SoFi, it's back big time. It's still down about 7.75%. We'll talk about this from a technical perspective as the stock dipped below that critical $5 level for the very first time today, currently trading about $5.52. This is on the heels of kind of a botched release of their Q1 numbers, which we'll get into on today's show. We'll take a look at kind of the loan mix. It'll give us a little broader perspective. If you're not interested in stocks that trade at about $5 or you're not interested in SoFi, I still think you're going to learn something about the consumer and the broader economy. When we look at a quote unquote bank like SoFi or a financial stock like SoFi, we get a window into the consumer, maybe get to draw some conclusions there as well. We'll come over here and look at these financials as well for SoFi. Now, they did give us a full year guidance update, expected basically right at $1.5 billion. Consensus was close to about 1.4. So they reaffirmed that. They gave us Q2 guidance on that revenue side between 330 and 340 million. Consensus was right about 340. So they're kind of hitting the mark. We've seen a lot of companies that we've done earnings videos on recently basically pull in guidance for Q2. In the case of SoFi, essentially kind of coming in within expectations. Part of the big gigantic stock dropping today was maybe kind of the shock of this release. As I said, it got released on SoFi's website, I believe by accident, maybe a technical error or a miscommunication, and the release went up and SoFi stock, boom, crashed big time, down below $5 per share. And like I said, after the full release was actually released on the website and people are starting to adjust these numbers, they're not horrible, okay? And we'll talk about that more on today's show. Now, what we have to figure out with SoFi is, okay, their upcoming year, yes, they're going to come in at that $1.5 billion. That's well north of 40% growth on that revenue side. For the upcoming year in 2023, analysts are expecting closer to $2.15 billion. And again, the fact that analysts are pretty close to these estimates based on what SoFi is giving them on guidance, we have to assume these estimates are within probably 10-20%. Now, unfortunately for SoFi, I think what investors are doing, they're not really looking for 2022 numbers. They're not even really looking out to 2023. It's beyond that, and it's the difficult comps that this company is going to have to run up against. And their growth is going to come down from kind of that 40% range down to 20% range. Now, that's still phenomenal growth. And on the earnings side, it looks like they're projecting, at least from an EPS perspective, some positive earnings over at SoFi. Now, one thing that we've always talked about here on the channel is SoFi was really overvalued. And even after the drop that we'll talk about today from a technical perspective as well, I mean, this stock was well north of $14 earlier this year, and now the stock is closer to $5. Part of that is the fact that this stock was just simply overvalued. And I've got a price to tangible book here, and I know that SoFi is different from Bank of America. I know they're different from Wells Fargo, and I know they're different from Citi, but quite frankly, people are going to start valuing SoFi based on a traditional banking valuation metric, because when we roll through these financials, this is starting to look much, much more like a traditional financial institution. Well, their price to tangible book is essentially, if you were to liquidate the company, the premium you're paying over the book of business. And Bank of America has often gotten a premium. They trade at 1.72 times tangible book. Wells Fargo trading at 1.24. This is just over the past year. Citigroup always has traded at a discount. They trade at 0.63. SoFi still trading at a premium compared to probably where a lot of investors expect this stock to trade. Again, it trades from a price to tangible book value that's almost similar to like a Bank of America or Wells Fargo, but to give it some credit, it was way overpriced. I mean, this thing was 4, 5, 6 times price to tangible book, just incredibly overvalued. That is probably the biggest reason, in my opinion, that a stock like this continues to pull back. Now, here's some broader economy stuff. I want to show this to you, kind of the loan mix that we've got going on over at SoFi. So we've got these home loans. I don't need to tell you what's going on in the housing market. the fact that prices are major elevated year over year. Prices have gotten way out in front of that market. And on top of that, now you got higher interest rates coming in. The 30-year mortgage, I think, is up over 5%. A lot of people were used to that being south of maybe even 3%. That is drawing up demand in these home loans. And we see evidence of here when we look at SoFi. So when we start looking out to Q2, Q3, Q4, a slowing home market certainly is in the cards, especially if you look at this data from SoFi, where they have home loans down 58% year over year to now it's its smallest book of business. But what has accelerated? Personal loans. Now that could be good for SoFi in the longer run. Maybe they get a better spread on the personal loans versus the home loans. Those were up 151%. But what does it tell us from a macro environment? Well, people are starting to draw on personal loans, which tend to be something people do when they are in financial trouble. I am very blessed to have income and to have financial security. I would no way ever take out a personal loan in the financial condition I'm in now. There's certainly some situations where I might, but I see that the fact that personal loans are up 151% year over year definitely does not spell a bullish Q2, Q3. And I'm talking about for the macro environment. For SoFi, it's actually probably pretty good business, quite frankly. Now, moving over to SoFi's financials, it actually looks okay over here, okay? From 82.5, this is on total interest income, went from 82.5 million up to 118. What we've noticed over the last year, this is a company that just acquired its bank charter, and I say just in the last 2 quarters or so. And I'll show you evidence of that and show you how many deposits that SoFi has on their balance sheet and compare that to maybe like a Bank of America and see how much growth potential there is for SoFi. And what we are seeing is it's driving down total interest expense from 35 million down to 23 because they're relying on their own deposits, I believe, to generate some of this interest income. So look how fascinating this is. You grew your revenue on interest income from 82.5 million up to 118, but your cost on that actually went down from 35 down to 23. This could be one of the reasons also why the stock is rallying back, because the pre-release didn't really have this kind of detail in it. It didn't have these types of figures in there. And so as investors start to digest this and they say, hey, this mix is actually getting better. Take a look at our net interest income from 47 all the way up to 94. That's basically doubling it, and you did not have to double your revenue on that. So that's absolutely fantastic, and that's a great trend, and that's why SoFi executed on that bank charter to drive these types of margins from that segment of the business. Now, on the non-interest income side, they went from 148 up to 235, so that's where you get that net revenue for the entire quarter coming in at $330 million. You take this net interest income, basically your income minus your cost, it gets you a net number at about 95 million. You add that to 235 million and you get to $330 million worth of total net revenues. Last year, you're at 195. Now, one thing we've got to factor in with SoFi is they're probably spending a heck of a lot of money on sales and marketing, because here's your non-interest expense. And I want to come down to the sales and marketing, and they went from 87 million all the way up to 138, but not necessarily a bad thing. If you're bullish on SoFi, and you've probably gone through the slide deck that this company has on every types of their financials, they make a lot of note the fact that they are converting a lot of their existing customers into other products that they might have. So you start with a personal loan, or you start with a student loan, and then maybe you get a home loan, maybe you get a savings account, maybe you do other types of things with SoFi. And we're seeing evidence of that when this company spends this type of marketing. Its growth is likely going to meet or exceed kind of the revenue growth that this company has, because again, they see kind of a lifetime value. I'm just spitting out the bull case of SoFi like you really need me to do that. Some of these other costs went out as well, up from 66 million up to 80, basically 82 on that technology and development side. Cost of operations up as well. General administrative actually went flat. That is a good sign as well. We've got provision for credit losses. That is a new line of the business, or kind of a new cost that SoFi had to recognize over last year. My guess is most of that has to do with the bank charter, the fact that they're carrying more of the loans themselves. They have to set aside these provisions for loan losses. We'll see how those progress quarter over quarter. Again, kind of a window into SoFi, more of a view into the consumer consumer. Obviously, the more these companies and these bank and financial institutions set aside for credit losses, the more their algorithms are telling them people are going to start to default. Now, we've got our total non-interest expense coming in at $439. So you guessed it, we take the $330 million worth of net revenue, we minus off 439, and this is going to turn off most investors. First of all, you got a stock under 10, nearly under $5 per share, and they're losing money. Okay. And it really didn't get that much better. Okay. It got a little bit better. Last year, we lost 176 million. Now we lost 109 million. So this is a non-profitable company. That is certainly going to sway some investors not to invest or not to take a shot in this company. From a balance sheet perspective, looks relatively similar to last year, other than the fact we have these interest-bearing deposits. Now, this comes down onto the liability side of the balance sheet because this is not SoFi's money. This is money that they're basically caretaking of their customers. But what I wanted to show you is, okay, last year they didn't have or at the end of December, they didn't quite have the bank charter. They didn't have deposits by then. They scored that, and now you see that this company has just over $1 billion in deposits. For reference, I went and looked. Bank of America, which is probably one of the kings of consumer deposits, they had over 1 trillion. So it kind of gives you an idea that I don't expect SoFi to get to 1 trillion in deposits. I tell you what, if it does, this stock will probably quadruple. I don't think they'll get to Bank of America's league in terms of deposits, but to be sitting at 1 billion and Bank of America sitting at 1 trillion in deposits, well, that probably leads you to believe there's a fair amount of room to grow when it comes to SoFi's deposits, and that certainly, as we saw in the quarter, drove down their costs. Now, we do see some more debt on the balance sheet from 3.9 up to 4.9. Again, this company is losing money, so it's just something to think about. Now, we don't typically look at cash flows, at least from cash flows from operations from financial institutions, and I'll show you why. It's weird. They have to recognize origination and purchases of loans because this is money that flows out of SoFi. Okay, this $3.6 billion. They're only able to recognize in the quarter itself the proceeds from sales and the repayments of their loans. And you see there's a wide gap here, okay, from 3.6 to 2.5. There's $1 billion spread here. And if you think about SoFi's business, they might purchase a loan towards the end of the quarter. It might not mature, or they might not be able to sell it until the following quarter. Well, they have to recognize that cash flow in the quarter it happens. So it really skews the cash flows. Now, if you want to analyze SoFi from this perspective, you can certainly look at this stock-based compensation. It went to 77 million in the quarter. Last year, you were at just $37 million. So again, another quarter where we see just absolutely egregious stock-based compensation, where this stock over the last year has gone from $14 per share down under $6. The executives have lined their pockets with money. Now, I understand the vast majority of these stock-based compensation was probably recognized due to the company's performance last year or over the last 18 months or so, and stocks and the economy has performed exceptionally well. We're reaching a rough patch, so this could be something that's peaking. It could be something that goes down tremendously based on the stock performance. It depends on the different executive compensation plans, but this shows you that, look, that's part of the dilution with this company as well. We talked about the fact that they took out debt issuance in the most recent quarter. They did repay about 2.6 and they took on another 3.6 or so. That was about the addition of about $1 billion on debt that we saw there on the balance sheet. The last line that is new for SoFi is the net increase in deposits. 961 million just over the last 3 months. That certainly can be a bullish sign for the company's financial results, as they'll be able to lend that money out. And it certainly showed in the most recent quarter, the fact that they drove down their interest expense while they drove up revenues. That certainly affected margins. Now, not enough to turn this company profitable, but obviously the bull case is you continue to drive this loan growth, drive those deposits, and that will potentially lead to profits for SoFi in the future. Right now, it's not. Now, from a technical perspective, there is not a whole lot to see here. This chart looks almost identical to Uber. It looks identical to Lyft. It looks identical to a lot of stocks that we've seen. They're in this dreaded downward channel. And those of you who've been watching the channel long enough know that this is a channel. If you want to go short this stock, this is certainly something that people have done. Again, it's no offense to SoFi or their business model or their shareholders, but you probably come over here to the short interest on this one. Yeah, it's 19% because all they're doing is they have screeners run by computer algorithms that find this technical pattern, and they probably identified it months ago at the beginning of the year. They identified it that this downward channel was in place, and look, everybody just puts on an easy short trade because this is just like an uptrend. When a stock is in an uptrend, it's literally just doing the reverse. It gets in these channels and it just continues to go up. Okay, well now, unfortunately, the same thing happens on the way down. Once you get in this channel, you are stuck in it until you start putting up some green candles up over the top end of the trend line. So if you don't want to get stuck catching a falling knife or just continuing to average down into SoFi, average down, average down, average down, if you don't think that this stock price continue to go down, you're absolutely kidding yourself. This company could do a reverse split. That's even worse for you as the shareholder. In fact, it wouldn't surprise me if SoFi stock continues to go down. They're probably going to have to do a reverse split because when your stock gets down to this $5 level, all of a sudden you're uninvestable from certain ETFs, certain mutual funds, pretty much all of them will not even be able to buy the stock based on the rules that they have in place. You need to wait for green candles to show up over this upper trend line, and you're going to say, I missed it. Well, the stock will go on a rally and then put up red candles on a pullback, and you just want to make sure the pullback is not lower than the previous lows. So eventually, SoFi starts making one of these upper channels and you buy this stock when it starts chopping up. This is not any guarantee that you'll make money. This is not any guarantee that SoFi will get in one of these upper channels like it's been many times. Here it is right here. Here's another upper channel. There's even smaller ones across the way. Here's another down channel. But what I've learned just by looking at stock charts, and you can literally just kind of look at SoFi's stock chart, when it goes on these downward channels like it's been many, many times before, it tends to break out and go on an epic run. But knowing when these downward channels end is very hard to predict, except when you break out above them. You see on all these downward channels, they tend to be broken out by some big skipping green candles on the upside. That's how I would play SoFi, quite frankly. This is in a downward channel. It's going to stay there for the time being until it breaks out. I wouldn't touch this stock from a technical perspective until it broke out. Then from a valuation perspective, it's still not crazy cheap. I know some of you have bought this at $10, $15, $20 per share. You think this looks crazy cheap. From a valuation perspective, still not crazy cheap, especially when you consider companies like Bank of America are doing buybacks and have a fair dividend yield. Same with Wells Fargo. Same with Citigroup. They're not all doing buybacks. Their dividends vary, but you get the picture. You've got an unprofitable financial institution in SoFi trading at a valuation that compares almost identically to a financial institution like Bank of America that has a buyback, a much lower valuation, is wildly profitable, and has a huge moat around their business. That all leads us up to an extremely, extremely risky stock, and one personally I'd probably steer clear of, quite frankly. Hopefully you guys enjoyed today's video. We'll be back in soon with more. Good luck with your investments.